Hey traders, this is Blake Morrow with Trader Summit, and I've got, it's Friday. I got Jim Welsh from Macro Tides. He's here to break down everything that Jerome Powell delivered to us from Jackson Hole, Wyoming today. How's it going, Jim?
It's going good. What an exciting morning.
It has been an exciting morning. Actually, it's been very whippy. Price action has been all over the map. The market reactions have been, if you take a step back and you're like, well, we're pretty much where we started for a lot of things. The markets are kind of back where they were at pre-speech. Dollar hasn't moved much from, so we're just kind of, we're sitting here. I want to get your take.
We're digesting,
digesting. Yeah. It'd be it, like digesting after a really, crappy meal. How are you reading all of this, Jim?
Well, okay. In Monday's weekly technical review, I made 3 points. That Powell would definitively say that the target is 2% not being changed, because there's been some scuttlebutt chattel that, well, maybe they're going to do something. Yeah. And I think he's been resolute over the last year in squelching that. And so he made that point very clearly. The other 2 points I highlighted, Blake, in Monday's weekly technical review was GDP and the labor market, because I went back to last year's Jackson Hole speech, and he said, for us to get inflation down is going to require GDP growing below trend for an extended period and some weakness in the labor market. So if you look at it, trend is about 2%, according to the Congressional Budget Office, 1.9, give or take. And in every quarter since Powell spoke last August, GDP has been above 2%. So they haven't gotten that. Oh, weakness in the labor market. Well, the unemployment rate last August was 3.7. It's now 3.5. So the two things he said we need to see progress on really hasn't transpired. And everyone's so focused on the consumer price index when the Fed is really looking at the core PCE, which again, he noted. But yeah, inflation has come down. I think it's likely to work its way lower. But I think one of the points that escapes most market participants, including most of Wall Street, is the Fed is looking out over the next 3 to 5 years. So, okay, the economy slows a little bit. And then at some point in time, theoretically, they're going to cut rates and the economy is going to reaccelerate. Well, how much slack was created in the economy during that period of slowing? And how much slack in the labor market? Because if not enough slack is created during that period of weakness, as soon as the economy accelerates, inflation is going to start to come back sooner rather than later in the next expansion. Excuse me. So I think that's where they're looking at, is like, hey, we need to create a pool of slack so that once the economy reaccelerates, inflation isn't going to immediately return, because that's what happened in the 1970s if you look at various charts. So again, what he said today was we need to see GDP growth below 2% for a period of time, not one quarter. And once we do get that slowing, it's not like you can, it's dropped down to a plus 1% and everything's going to be just fine. No, you get overshoots. So that's why I've been saying, I think we're going to see at least 1 quarter of negative GDP growth. And I think the odds favor that as we get into early next year, we'll see a recession. The labor market. Well, the Fed has penciled in on the median dots, and we got a new one in September, that the unemployment rate is going to go from where it is now, around 3.5 to 4.5. Okay, so again, when we start getting the things that the Fed has been telling us, this is what we need in order to have confidence that, inflation is coming down now, it's great. But to have confidence it's going to stay down. I don't think the stock market especially is going to respond to that data when it starts to really come in, because the market's rallied on the idea we're going to have no recession. So
I just was thinking about this, and I was looking at some of the screenshots the images that you sent over for us to use. Should I have been showing those during this conversation?
Well, we can cover it real quickly just to nod the great effort that I put in creating them.
We should do that. So let's start off with the first shot that you brought, talking about Powell and GDP growth. and how we might slip in a negative GDP growth once this year before heading into a recession. So
yeah. So again, I've studied monetary policy for a really long time, and I think what I try to do, Blake, is put my mind in a place where I think, where's Powell? With the people sitting at that room, what are the things they're going to be talking about? So in the September macro tides, I'm going to go do a deep dive into the real funds rate. Why? Because in coming months, that's what the Fed is going to be debating in terms of policy next year. So again, I thought he would reaffirm inflation 2% target, and he said 2% is and will remain our inflation target. In other words, it's that close to a Federal Reserve Chairman flipping off anybody who doesn't believe him. Again, the skeptics. Oh yeah, don't worry. Next year, inflation, unemployment goes up. They'll change their minds. And I wouldn't bet on that quite yet. As I said earlier, we need to see sustained period of below trend growth. That was his speech last year. And some weakness. Well, we're going to get the labor market. So what did he say this year? Well, has come in above expectations and above its longer term trend. And the chart below shows that in the last 4 quarters, the average is, I think, 2.55%. Well, that's pretty significant above 2%, especially when you want it below 2%. So this is what they need to see to have confidence that inflation is going to stay down if and when it actually gets closer to the 2% target. Is the stock market ready for GDP growth to slow by half of what it's been doing, and the impact that will have on earnings? I don't think so, but we'll see. First, we have to see the slowdown.
Right.
And
okay.
then the second slide was looking at the labor market, and so he, as I noted, last August the unemployment rate is 3.7. Today is 3.5. Requires some softening of labor market conditions. All right. Well, guess what? We've seen some indications, things like the JOLT survey, the number of people quitting jobs. Obviously, average hourly earnings are starting to come down because people aren't going to get 5 to 6% wage increases every single year. Everybody got to ramp up. And as that ramp fades into the past, beyond the 12-month window of rates of change, wages are going to come down. Great. But for them to see and have, again, confidence that inflation is going to stay down, they use this measurement of the non-accelerating inflation rate of unemployment, NAIRU. And so right now it's at 4.4%. The unemployment's at 3.5. Oh, and as I noted, the last dot plot said, yeah, we all think the median projection is for 4.5%. What a surprise. They think that the unemployment rate has to get above this to create enough slack so that we have inflation not only come down but stay down.
So this is, and you can obviously see we're not.
No, we're way below it. So at a minimum, you need unemployment to tick up above 4%. And when that happens, it starts other dominoes to fall.
And I think people got to take a step back and go, okay, well, that was COVID. This was the GFC.
Yep.
Normal conditions. I'd say normal, normal recessions, right?
Normal business cycle.
Normal business cycle. There we go. So, until you start to see this happen, I don't know how the Fed's going to be too bearish on labor.
Now, politically, can Powell specifically say, okay, this is what we need to see. We need to see the unemployment rate tick up a full percent, which represents about 1.5 million jobs or so. He's not going to say that politically, but anybody with half a brain, you understand what they're thinking, why they think the way they do. This chart expresses that, I think, very succinctly. And the Fed needs to see the unemployment rate start to trend up before they're going to consider that policy has reached the right level. And so that means to me, higher for longer. I don't think, as I've said before, I don't think they're going to increase the funds rate at the September meeting, but the November meeting, again, the data is going to dictate it.
And just let me clarify, if you're at home thinking, wait, do I have half a brain? That's okay. I've got a quarter of a brain. So don't worry about that. Okay. That's why we got Jim here.
We try to help people by educating them. I mean, honestly, Blake, I listen to CNBC all day long. I have it on the background.
God
right?
Bless you. Yeah.
Because once in a while, there are people on there whose opinion I respect. They just had Robert Kaplan on earlier, former Fed president of Dallas. They had Richard Fisher on. These guys are really, I like them. They're really common sense, guys. Those are people are worth listening to. Most of the talking heads, honestly, don't understand monetary policy at the level that they really should, given the circumstances that we have. So what we've seen over the last year is this idea, the Fed's going to pivot. Remember last year, Fed's going to pivot. Fed, all that stuff. And so, again, big moves happen when people are surprised. So last year, everyone was looking for a recession. Early this year, recession. Then we had the banking problem in March. Well, everybody got off sides and the market made a big move up because, gee whiz, we didn't have a recession. Now everyone is mostly positioned for no recession. Well, what's the next big surprise potentially out there? The Fed wants GDP growth to slow materially from where it's been, and they want unemployment up, because those are the things in my mind that they've set up as preconditions for having confidence that inflation is going to recede enough and then stay down for the next 2-3 years.
All right. So, okay. So Jim, I get what you're saying, and it's, and I have to say the tide's shifting a little bit. I think people are becoming more, how should I say, acknowledgeable that we might actually not, we will still face a recession. But it's funny, you're seeing the tide shift right now. So,
slowly but surely.
Where you haven't seen the tide shift is the dollar. The dollar has been rallying, and we broke some pretty big resistance this week. And what are we going to do here with the dollar? It looks pretty damn bullish.
Well, a month or so ago, we were talking. The idea was it was going to rally to 103. It was under 100. Okay, I think we're going to rally to 103.50, maybe up towards 104. We took out the first trend line that you can see, the more steeply sloped downward trend line. And as you pointed out this week, you took out the other trend line, and it's been trading above 104, which was kind of, in my mind, a key resistance. Opens the door up to the 105.50. The 105.88 was the high back in March of this year. So to me, that implies that we're going to see the dollar strengthen in the short term. And part of that is being driven, obviously, by maybe a shift in perceptions about Fed monetary policy. Because initially, when Powell started talking, what did the dollar do? It sold off. And then it's like, oh, wait a second. And then it strengthened. So the other thing is the European economy looks pretty weak. I mean, I think, it's a fait accompli that it's going to be a recession. So if you look at that, that means the ECB has been talking tough, but they're more likely to, not raise rates as much as they've been indicating, which I think is, is not supportive of euro strength. So again, I think the dollar looks like it wants to move up to that 105.50, 106, and then that's the next big test. At some point in time, you can see the bottom panel is the RSI. It's getting near the overbought level. So now it's just a question. There's got to be shorts that, you take out these trend lines, you get short covering. And one of the things that we talked about 4 to 6 weeks ago when the dollar was trading around 100, and I'm pretty sure 1 week we showed a chart, was that dollar positioning had become very bearish. In other words, a lot of people were betting on the dollar declining more, in part technically because you took out that 99.78 level, and then, dollar's going to lose its reserve status and all the rest of that.
Right.
And again, fortunately, we were looking for that drop down. There was a triangle looking for a plunge. And once we got it, I think we were helpful in terms of saying, folks, it's time for a rally. Yeah. And so I think we've been able to give folks a pretty good, map, if you will. And, the near term says likely to go higher.
All right. Well, we have gold, and gold is, managing to hold this pretty key support right here. But its move's been kind of lackluster, especially if you match it up against what silver's been doing. So what do you make it? What do you make of gold here?
I still think, in early May, the idea was 5 up, longer term bullish. We need a wave 2 correction. Wave 1 lasted 30 weeks. So that implied 3 to 4 months of correction in gold, just from a time standpoint. And the pattern looks like A down, B up. And I don't think we've completed wave C. I think gold is going to definitively drop below the red line that you just drew. And targets are 1850 or less. And it makes sense. If the dollar continues to push up, I think gold is going to have a spike down. But I think that spike down should be bought. Because I think ultimately, once this correction is over, we're going to see gold rally to a new all-time high. But it would be beneficial, Blake, for gold, I think, to take out these lows because it'll create more bearishness. People getting stopped out, tossing in the towel, kind of like what happened to the dollar. Took out that prior low below 101, and okay, now it's really going down, which set the stage for the rally we've seen. I think the same thing could happen with gold. We can see the RSI is getting pretty oversold. So this bounce has maybe set up the potential that gold drops below these lows, but you get an RSI divergence where the RSI is higher than it was a week or so ago. So again, I just think there's more to come, but we're looking for it as a buying opportunity. So under 1850, I think people should, commit a third, scale in, just because could it drop down to 1810? Yeah, that's wave 4 of lesser degree, 1806. So there is, there's potentially, and with gold, a lot of times you get these spike moves, both up and down, right at the end of moves.
Yeah. Well, you've covered gold pretty well, and I want to take a look at the bond market because everybody is wondering, are yields going to break out? Is TLT going to break down?
Yeah.
What are you seeing here? Because obviously yields are on everybody's mind right now.
Yeah, and I understand it. My thought has been is we were, initially I had said a couple months ago, hey, it gets down to 99.60, buy it. Then I canceled that, I think, in early first week of July, because I think we're going down towards those lows of last October. This past week, it was like, all right, 93.60, take a partial position. I'm not convinced yet that TLT has made the absolute bottom, that there may be one more drop down. If it does, I think that's time to buy as you're circling there at the recent price low in the last 5-6 trading days. TLT made a lower closing low, but you can see the RSI registered a positive divergence. So to me, those are the things that were like, okay, time to put a toe in. And then if we get more weakness, I think it's time to buy some more. My macro view is not that the economy is going to avoid a recession. I think we're going to see a pretty meaningful slowdown. And when that develops between now and year end, I think TLT is going to rally. And my guess is a move up to 98 from where we are seems very reasonable, up to that resistance, that sideways resistance. And whether it can make it all the way back up to 109, hey, we'll cross that bridge if and when it stops going down and starts going up.
Yeah, that makes sense. Well, I'll tell you that the stock market has been pretty weak, and you brought up a chart today of the semiconductor index. So what are you seeing here with semis?
Well, the thing, the NVDA hysteria, and I think that's appropriate term for that. You can see how it gapped up on Thursday, and the opening was within pennies of the high for the day, and then it sold off, and so it made a higher high, lower low, obviously closed down. That's a key reversal. That, in my opinion, shows that whatever reason, a lot of sellers decided to show up and sell into that pop. that implies, and as I said last week, you had 5 down. There should be a rally. I thought 150, 152. Well, it got a little crazy yesterday or Thursday morning. Yeah. Is that yesterday morning?
That was yesterday. Yep.
Crazy how much happens sometimes. But notice how it came and hit that trend line, that blue trend line. So it broke that trend line, did 5 down, then popped up to it. I can't get above it, and it puked. So if that was wave A, down to 5 waves down is wave A, we got a B wave bounce. Wave A was down, declined about 18 points, 17, 18 points. Take 17 from 156, and you're at 139-ish. So, and then there's a gap off on the left-hand side at 134.31. So to me, Blake, this looks like a retest of that red rising trend line. Seems very likely. And if the king of the technology stuff, which is semiconductors, encapsulated by NVIDIA, if they're going to be correcting down this much, I think, overall technology is going to be correcting. We know that, the tech stocks have a big weight in the S&P. So my assumption here is all of this is going to show, we're going to see more weakness, So, but this key reversal was extraordinary. In my opinion, it was pretty dramatic yesterday.
Yeah, that was a big one. And just for those of you that were looking at NVIDIA, it was actually 161% extension. We gapped above it and fell right at the open. So as Jim's pointing out. Yeah. So interesting.
And then just looking at the S&P again, what I'm pointing out here with those red arrows are key reversals days. So we saw one on 727. And then as I note, the 810 and 824 again yesterday. So, those are periods where selling is overwhelming the buyers. You made a higher high and then you give it all back and you go down and you close down. I think that has to be respected. I think a pullback under 43.35, so last week was like, okay, we're oversold, we're going to get a bounce. And then I think we're going to go down and take 43.35 out. My take is that will complete 5 down in the S&P, and we're going to get then another bounce. Now, the one caveat is if things could get really crazy, potentially. If bond yields, in fact, tick up and make one more higher high, Blake, I think that at this stage where the weakness is and where the market is set up, you could see pronounced weakness in the S&P. So it doesn't just take out 43.35 by a little bit. All of a sudden, we're pushing 4,200, 4,250, that it accelerates a little bit to the downside. So, we'll just see. But, the idea last week was, hey, we're going to get a bounce. I thought Powell was not going to give the market what it really wanted, was hints that they're done. Maybe there'll be rate cuts next year, any of that stuff. And I think as the market fully digests what he had to say and absorbs that, okay, they really need to see the economy slow down, unemployment tick higher. That's not a bullish sign for the market. And so the bias to raise rates is still there. I think Powell made that clear. So again, my assumption is those key reversals mean something. And I think we should respect that there's additional weakness likely in the S&P.
Well, guys and gals, if you think that Jim week in and week out gives you some great, advice and helps you put the puzzle together with all these puzzle pieces, make sure you give him a thumbs up and subscribe to the channel down below so you don't miss any of this content. Jim, how do people follow your work? How do traders follow your work?
Macrotides.com. If you'd like to see a recent issue, because I always go into obviously more detail than you and I can ever cover, because we're covering a lot of ground quickly. And I think it's important for people to have a better understanding of the economy, monetary policy, in conjunction with technical analysis. I think ultimately that's where, if you're a trader, and I think you've expressed this yourself, Blake, that over the years you've kind of grown to combine the fundamental with technical. Yeah, it really has helped me tremendously to have higher conviction about what I think is going to come when I can see the things kind of interlapping and being intertwined. So
100%.
Jim Welsh, macro @gmail. I'll send you a recent issue.
And remember, if you're a Trader Summit listener, make sure you mention that to Jim. He'll give you a discount. So,
absolutely.
All right, Jim. Well, I want to thank you for being with us today. Thank goodness you fared through the eye of the storms that blasted through San Diego, California last week. And glad to have you back.
Hey, always good to be here, and have a wonderful weekend.
You do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.